Hello, and welcome to Credibly Challenged, a podcast about bank risk management. My name is Matt Bisanz, and I'm a bank regulatory partner with the law firm of Mayer Brown. Joining me today is Jay Luzar, a former regional bank treasurer from the Midwest. And as many of you may know, Mayer Brown is focused on outreach to the regional banking market. And so I think it's really going to be helpful to get some of Jay's perspectives on treasury services, treasury management, and all things asset liability related. Thank you, Jay, for being on the program.
Thanks, Matt, for having me.
So you've seen a lot in your career on treasury management, and maybe what would you say is the way it has changed most from when you started in ALM?
Yeah, man, I think if you rewind probably 15 years to the time prior to maybe even Dodd-Frank, I think historically Treasury always was part of balance sheet strategy. But I think the complexity of the regulatory environment, and not just that, but the market overall, the wild swings in interest rates, the wild swings in market conditions, whether it was the great financial crisis or the pandemic, just brought Treasury back in, front and center, because issues like funding, issues like capital, and then certainly as you get into balance sheet management and pricing, that becomes even more important as margins tighten, as rates fall, as rates move up and down, making sure that pricing is appropriate and earning the appropriate returns for the company. So, those are probably the things that you've maybe seen the most, is just that intensity in the Treasury and the intensity of the focus in Treasury.
And one of the parts of the conversation I often have with regional bank treasurers who are outside of, I'd say, like the major market of New York or even sometimes on the West Coast is that the communities aren't as big. That when you're in Ohio, when you're in Indiana, Nebraska, like you may be the treasurer of a significantly sized $50-100 billion bank, but you don't have the same network of contacts, the same servicing from the investment bankers and others. How did you kind of manage, like stay in the most sophisticated relationships and market position while being at regional banks?
Yeah, we were fortunate. I guess I was fortunate enough to be in a role where, we were one of the larger regional banks. Again, not a sub 25. And I think the challenge for them, for banks, call it sub 50 even, is, the diversity of your balance sheet, right? If you don't have, capital markets business, for example, that gets a little challenging because, again, you're dealing with more of a homogeneous set of products, right? Whether it's, the consumer assets or in the business banking side, it's going to be largely, what other larger banks might consider to be small business, right? Mm-hmm. And so, I think that's part of the challenge that the smaller banks face in getting that visibility with some of the bigger investment houses. Now, that being said, those banks still get, they still get the folks knocking on their door, right? Whether it's, I don't want to name the investment firms, but there's a number of folks that target those smaller regional banks to help them along, and so. It's different. They get the exposure, but they don't get the exposure of the money center banks, if you will. And so, and what comes along with that then is just that, you got to give credit to the money centers, right? Like they come up with very, very creative solutions to situations. And I was fortunate enough to be on the side of one of those transactions where it was really well thought out. I don't want to say super complex because it wasn't when you break it down, it's not really all that hard. But it was really, really creative. And that again, that idea came from a money center, and in conversations with money centers about, how we should think about that type of transaction.
Interesting. One challenge I've had in working with money center banks and scaling transactions is the reputation issue. And I think maybe that's something not at your most recent job, but at some of when you were at some earlier banks that might have been a bit smaller, is that if you're facing JP Morgan, Morgan Stanley, and you're an investor or some kind of investment like banking transaction, you don't really worry about it, that regardless of what the government says, they're too big to fail. And so you take some comfort in not only their fortress balance sheet, but also that implied backstop. But until I think last year with Silicon Valley Bank, and certainly still in I don't think the $25 billion banks have that kind of say, well, there's a bit of bank credit risk here, that if something goes wrong and I'm an investor in this, I might lose, even if it's a fairly safe senior piece of debt. When you were having those conversations with funding sources or other types of investors, and we're trying to design a balance sheet that could be competitive with the money center banks, how did you have those conversations?
Yeah, it was funny. It was I touched on it earlier, like the changing of credit spreads.
Mm-hmm.
And that conversation was absolutely real, right? When you got to the Silicon Valley,
Mm-hmm.
I'll give you an example. We issued paper in my role, and this was just unsecured debt, and we were in the I want to say sub 50 over the benchmark in the spread space. Fast forward past Silicon Valley, that spread jumped to 350, 400, right? Like, it was really, really crazy. And so I think the dynamic of I think it did open people's eyes that, look, some of these banks that may have been on the wrong side of things, it's going to cost them. And so I think you've seen that reflected in not just the widening of the spreads, but how stable and sticky that widening has been, right? So, and by the way, this is regardless of the quality of the regional banks. They're still much wider than they were before.
Right.
And I think when you have that much liquidity pumped into the market, with during the pandemic, that's everyone's fighting to deploy it and put it in a spot where they think they can earn it. I think now they're more discernible, right? They're gonna invest and spend the money in the right spots, and so I think we've seen that with the widening and stickiness of the spreads, particularly in the banking space.
Yeah, no, I've seen some tragically high spreads. I think I saw one was over 1,500 basis points, and I was like, whoa, boy, that's a really nice return for that investor, even if you're taking on bank credit risk. But yeah, it can be painful when you're trying so hard to manage those spreads and communicate to investors about the quality of your bank and the protections in an instrument. How do you then have the conversation internally about not giving away all your hard work? That I had a high yield savings account with a bank, and I just moved over to a newer bank that was offering a better yield. And I look at these rates, and I kind of know that for some of these banks that are paying them, they can't be offering a competitive rate of return to their investors, just given how much they're paying for what are, like in my case, I have no other relationships with the bank. As soon as the rate goes below a certain amount, I'll move elsewhere. Like I am the not sticky deposit in this case. And I'm sure you had people on the business side saying, hey, we want to offer this new product that's going to cost this much in our deposit interest rates, or I want to offer a loan that is going to have this incredibly low rate that's going to be locked in for a super long time. And now you're being the bad guy, the Mr. No. How was that conversation?
Well, it's not always enjoyable. What I would tell you is a couple of things. So you're bringing up some really interesting points. And again, as I mentioned before,
Yeah.
I was thinking about it a lot over the
Yeah.
weekend and even prior to that. Look, you're getting a competitive rate because the marginal cost of that deposit it beats anything they're going to be able to issue in the markets, right?
Mhm.
And that's just a fact. And so when you think about the marginal cost of that funding, that's really really important. And a lot of times people say, well, I'm gonna pay an extra 50 basis points on this deposit, and it's just going to cost me an extra 50 basis points. Wrong. When you pay an extra 50 basis points, you're paying it on the whole book, or at least a significant chunk of that book. And so when you're paying that extra 50, it's not on the extra $100 million you're going to get in funding. It's actually on the maybe $2 billion that you have in funding. So that marginal cost is not just that 50 basis points; it's much higher.
Mhm.
And so when you start getting into conversations about issuing debt at five or 600 over, what's that look like on your deposit base? And maybe that sticky dollar or that non-sticky deposit that you're going out there with, and you can assume that you're going to keep paying that high market rate. Renewal rates are probably going to be fairly high.
Mhm.
And so again, the more you pay, the more sticky it is, right?
Yeah.
And so you have to weigh that marginal cost. Same thing on the asset side when you're talking about loans, except that it's not obviously your returns are going to factor in that higher marginal cost of funding.
Mhm.
But what you think about really is the marginal return on the capital you deploy too, right?
Mhm.
So like if my cost of capital as a bank is 12, 13, 14, 20%, my hurdle on that loan is really high.
Mhm. Yeah.
So that's been the real challenge with banks for and with banks for a number of years. And
Mhm.
it's how do you think about um, deploying that capital and pricing the loan appropriately? And that's where the party of no comes into play, right? Like
Yeah.
I'm going to come in and say, you guys, look, this isn't great. Like your cost of capital is 20 and the return on that loan is like 10,
Yeah.
9, 5.
Mhm.
Like
Mhm.
if you're going to tell me you're going to do that 5, where's the 35 coming from? Because I got to balance it out and and make that return.
Mhm.
And so that was always a really um, tough challenge for the bank treasurer. And I think it comes down to this: the smaller the bank, the more meaningful that marginal deployment of capital is, right?
Mhm.
So when they do this, when the smaller banks go out and they're competing with the big banks can get away with lending at a below hurdle rate on the cost of capital because they're going to make it in fee revenue somewhere else.
Mhm.
The smaller banks don't have that, right? Like it gets more challenging for them, and so pricing their assets becomes super important, and it gets even more challenging. And so yeah, it's the conundrum for small banks, right? Which is I
Mhm.
gotta price these assets to make money, but I'm competing against these enormous companies that can come in and get me. So that's why I think, that's where I think small banks are probably more on the small business side, because
Mhm.
the one thing I do think small banks have a competitive advantage on is is the concept of relationship banking. They know their
Mhm.
customers. They have to. The communities, as you said earlier, are smaller.
Mhm.
They're tighter. There's the water cooler
Mhm.
and there's a lot of conversations that go around. So that's where I think they actually have a competitive advantage.
Yep.
Um, but again, it's making sure those assets and deposits are priced right, because if they're not, you're just not going to make money, and you're going to tread water. And
Right.
look, maybe that's okay. But it's a tough environment for sure.
Yeah. One area that's been particularly tough for, I think, a number of banks has been commercial real estate. And something I did not fully appreciate until a few years ago was how most commercial real estate loans are not amortizing loans. That when I have my mortgage on my house, I know over 30, it's a 30-year mortgage, and at the end of 30 years, it will be paid off unless I do something in the meantime, but like it will be paid off. And a lot of CRE loans are not amortizing, that they are predicated on either a sale or a new loan at the end or some kind of refinancing, because principal is not paid off in the same way resi loans are. And I've been thinking about that, in particularly for someone like you in treasury management, that when you're talking with a banker about setting an interest rate, say on a commercial real estate loan, or even making the loan, you might say, well, look, this is a 5-year risk. We're going to make this loan at 250 basis points or 300 basis points, and like we have a high confidence that there will be an ability to repay over the 5 years of the loan. But you also have to think like, well, we get to the end of the 5 years, and what if there's, after COVID, there's 35% vacancy rates, or now with higher interest rates, the base rate has gone up to 5% plus, say, 300% spread. And you're like, well, okay, we'll just not make the loan, but that's not really an option, because if you don't, the borrower is not going to find new financing, and so they'll just default at the end of it versus defaulting during the life of it. So, like, how do you think through that aspect of lending, which to me is just a black box?
Yeah, this is where you got to trust your credit underwriting teams, right? And really partner with them to make sure that everyone understands, what these deals look like. And look, I think one of the things you look at is the cash flow on the property, right? Like if they're making revenue and it's consistent, right? And I think the best example you can think of is like one to four family, right? Or apartments or something like that. Like multifamily housing, I should say.
Yeah.
Those are typical. Look at the environment, right? Like you got a housing crisis in the country, and so when you have that, you know that the revenue streams from that type of asset are going to be fairly consistent, and so you're okay re-underwriting that loan. Now, the property owner might not be okay with it because they got to pay the higher rates, as you mentioned.
Right. Yeah.
But they don't have a choice, right? And so that's where you just have to be smart about how you're underwriting the credits. What type of what is the revenue stream? What's it look like? If it's office and it's in the urban in urban areas or urban settings, like that's those are tougher spots right now. But again, commercial real estate is a cyclical business. It's been like that for decades. I think the pandemic is a fairly sizable curveball, to be sure. But again, it does eventually turn. I don't know when office turns, but look, multifamily is a big deal. And I live in, we talked about the Midwest, and I live in a fairly decent sized Midwest city. We're seeing a lot of office space in our downtown turning into apartments because they can't rent them fast enough, right? And so what you're seeing is these developers rethink their properties a little bit, which is good. That's creative, and as long as there's demand for the product or properties, then you'll be in good shape.
Yeah, the building behind our office is here in DC. It used to be the headquarters of the Peace Corps, and as a poorly funded government agency, I think they eventually had to seek cheaper rent, or just the building itself was getting unsafe. And so about maybe 2 years ago, they gutted the entire building, took out like the walls and everything, just down to the concrete. And now they're turning it into, like you said, apartments. So that is an interesting reuse of space. Another thing about Treasury that I've always wanted to ask someone in your role, that it was something that I've had to explain to a lot of my colleagues, is the fact you have banks and holding companies, and you kind of have a choice in how you fund the bank out of the holding company. That like you can push down pure equity, you can push down deposits if you wanted to. In theory, you could push down different types of debt, but like you have a mix that you can fund the bank with. And I didn't realize people did it differently until the Fed came out with their long-term deposit proposal last year. And then I started reading some of these investment bank reports about who was going to be affected. And it wasn't just who needs to raise it in the aggregate. Some were like, oh, well, this bank holding company is fine. It's got plenty of long-term debt, but man, they funded their bank through this thing that like totally is not going to work with the new long-term debt proposal, and they're going to have to really restructure their funding and issue new types of securities. And I was like, huh, like that's an interesting question to ask someone of like why, of how and why do you pick different ways to fund your subsidiaries in these larger groups?
Yeah. So it was interesting because the to your point, the long-term debt rule, depending on in the TLAC rule, I think
Yeah,
you were bundling
yeah.
those two together, right? And long-term debt rule and TLAC are two entirely different things. They're related but different, and so you
Hmm.
got to be careful on conflating those. I think investment bankers did a wonderful job conflating TLAC with the long-term debt rule. They were different.
Hmm.
So the way we thought about it is we historically, and this was
Hmm.
we were not a long-term debt requirement bank,
Right.
and when I was in the chair. So what we would have thought about is you know my parent company needs cash, right? It
Hmm.
needs cash to pay dividends. It needs cash to um, pay existing debt, pay off debt, and so what you would have said is historically you would have said, hey, all right, what's my holding company cash flow look like? I don't want to run across let's say less than 2 years. I want to be able to fund 2 years of my parent cash, um, based on where it sits. And once something hits within a certain window, you assume that you wouldn't be able to refinance it. So you go out and you get it ahead of time, right? And it's the
Hmm.
old adage: it's better to issue when you don't need it than it is to issue when you need it.
Hmm.
Uh, so that was part of it. It was mostly that when you thought about debt. And then, if the parent didn't need it and you wanted to issue debt for the bank, you issued it out of the bank. Now, the benefit of doing that is, um, when you issue out of the bank, it's cheaper, right? The
Hmm.
cash flows, because the bank is the main profit generator for the company,
Hmm.
closer to the cash flows and you're closer to debt payments. So your spreads typically, hold co to bank. If you were issuing on the whole co, typically 10 to 15 basis points higher,
Hmm.
than the bank, and so it was cheaper to issue out of the bank. Well, now with the holding company, because you have to have total loss absorbing capital, the long
Hmm.
term debt rule, which is similar, right, where
Yeah.
you have a certain amount of loss absorption sitting at the holding company,
Hmm.
and it's for the entire holding company, not just
Hmm.
the parent, right?
Right.
Um, and so what you have to do now is consider, okay, I got to issue this out of the holding company, and then what you're doing is you do some intercompany borrowings, right?
Hmm.
Where not just hey, holding companies issuing debt and it just gives it to the bank. You actually have to do an intercompany borrowing to move that money. Otherwise, you have to do an investment in sub, which increases the capital of the bank. That's another way to do it, but typically it's an intercompany. And so it's forcing banks to rethink how they do it.
Hmm.
Particularly the banks that are over $100 billion.
Yeah. Interesting. So you talked about the 2-year planning horizon, and I'm sure you used some fairly sophisticated models when you were doing that. Um, Something one of my mentors years ago, Scott Annenberg, talked about was back in the old days of Basel One and Basel Two, there was this acronym ICAP, for capital adequacy and assessment planning. And it's barely mentioned in the capital rules. Like I think it's like a throwaway at the end of a bank shall have an appropriate capital adequacy assessment process. And since the 2008 financial crisis, like we have capital planning, we have the capital plan rule, we have the stress testing guidance, but there still is a bit of opacity around, like the capital requirements are 8% tier one, 10% total capital. And then like I was looking this morning at a report out from Raymond James, and it was talking about a bank that was trying to target like an 18% um, tier one capital. And like this was a routine regional bank, healthy regional bank, no unusual stuff. And I'm like, well, that's an interesting extension of its capital adequacy assessment, that like it sees a need to have effectively like an 8 to 10% cushion above the regulatory minimum. And like that's not written anywhere in the guidance I read, but clearly it's something like their treasurer thought was important in the capital planning process. How does that whole ICAP process work?
Yeah. This is the way 18% sounds high to me too, for what it's worth.
Yeah.
I wonder too if some of that is the TLAC coming into play, right? Because you got to issue, because when you do TLAC, you can issue tier one, that counts. So you're issuing preferred stock, non-cumulative preferred. So maybe that's part of it. I don't know, but I'd have to look at the numbers. Here's how we would have typically thought about capital. And the guidance is pretty clear, right? Like well capitalized common equity tier one's like 6.5, like you said, 8% tier one, total, 10%. What we would have done is we would have used our stress test to help augment that a little bit, right? So look, if you're getting to 6.5% capital, let's all be clear. The regulators are going to be on you very, very quickly, right? And so what you don't want to do is even come close to that. Even like we just saw the stress capital buffers and capital requirements come out here like last week or the week before. And so if you get into that well capitalized space, you by the letter of the law, yes, you're well capitalized. The issue is like as you're working your way down, people don't think that trajectory is going to stop. Right. And so your point, so what you really want to do is you want to say, listen, I'm going to set, and the regulatory guidance has been pretty clear, whether it's in actual codified, like in the register type stuff, or even in historically in instructions in CCAR. And if you look in CCAR, they want you to build out your capital stack. And so how you think about it is, I want a framework that helps me think about, okay, post stress, like, do I ever want to go through a stress and get to a certain level? And if I get below that, I'm in trouble, right? And so what you do is you'd say, okay, I have the regulatory minimums. My typical stress consumption or consumption of capital within a stress is 200 basis points ish, right? So in a stress, I'm going to eat through 200 basis points. So 6.5 plus 2 is 8.5. That 8.5, I never want to get below 8.5. I don't even want to, or I'm going to manage to stay above that as much as I can. So what happens is once you do hit that 8.5, you start triggering all these remediation actions, right? I'm going to shrink. I'm going to slow my loan growth. Any share repurchases are going out the window. Don't ask about a dividend increase. We're not doing it. And other capital preserving activities. If I have to issue, I might issue on the way down, just because once I get there, it's probably going to be super expensive. So, again, you don't want to issue capital when you need to, because that's worse than debt. But it's an option. So what you would do is you build the stack a little bit differently. And this, by the way, I'm in the minority. Well, I'm not in the minority. I've talked to a lot of my peers in the past. We all said the same thing. Look, stress testing fundamentally is a very valuable exercise, right? Not only because it helps you establish like thresholds where you're going to operate, but really it gives you insight into the risk of the business, right? And it forces you and the company in general to think about risks holistically, right? And you have knockoff risks, right? So if I have a liquidity event, I'm going to face a crisis of credit, right? Or if I have a credit event, I'm going to face a crisis of liquidity, right? And we saw firsthand with SVB and the others at that time, where they had a liquidity event, they were struggling, and the minute you have that, the minute the market smells blood in the water, look out. And sometimes it's quick, sometimes it's not so quick. These stress tests, whether it's liquidity or capital for that matter, are super valuable in helping you set the right operating thresholds and then managing to those and living by those. Because if you don't, then you're going to be in some trouble.
Yeah. Now you have experience coordinating kind of enterprise-wide efforts around this kind of capital management,
Yep.
liquidity management. And I used to be an accountant before I became a lawyer. And so I seem to recall that kind of the other side of the house to Treasury is the controller. And they're the one who's booking transactions and like reserves and impairments and stuff like that. And I to me, I think of it like there's like AOCI, which is like pretty obvious from a capital perspective of it could have an impact. There's hold to maturity impairments, which they don't flow through the same way for GAAP purposes, but there's a number on your hold to maturity securities that you can go to the comptroller and get. And then there's the possible losses on hold to investment loans. And I think like CECL affects some of that, but not entirely, and certainly not booked in the same way. But when you're trying to push those capital numbers up as high as possible, and you're talking with the comptroller, and you're like, hey, how bad is it going to get on the way down? How do you guys have that conversation around the different possibilities of loss that are on the bank's balance sheet?
Yeah, I think you have to understand the type of loss you're talking about, right? And
Mm-hmm.
so whether you have a say in how it's realized or not. So,
Mm-hmm.
and
Yeah.
I'll explain what I mean by that.
Mm-hmm.
Look, interest rate based losses. You mentioned AOCI.
Mm-hmm.
Um, those are interest rate based losses, and I, as a bank, have a choice as to whether or not I want to take them. And the reason is because you're using securities as a source of liquidity when you need it, right?
Mm-hmm.
And so I may choose not to realize those losses, and I would choose not to realize them because I wouldn't sell the bonds.
Mm-hmm.
And so I will lose liquidity value, make no mistake, right? So
Right.
go to a counterparty, whether it's the home loan banks, whether it's the Federal Reserve, or whether it's just a general market repo, I'm going to lose liquidity value because the value of the securities is lower. And then certainly, depending on the time, depending on the period and how stressful it is, additional haircuts are going to get applied to these bonds. But I don't have to sell them, and that was the biggest thing with that whole period of SVB is the banks banks with big AOCI marks were getting hammered by everybody because of the potential loss that they would take. Well, again, I only have to take a loss if I have to sell the bonds.
Mm-hmm.
And so, one of the actions that the Federal Reserve took in recognizing this was to say, hey, look, if a bank pledges me securities, I'm giving them full market value of the bond or full
Mm-hmm.
par value of the bonds. It was a
Right.
way to instill confidence in the economy
Mm-hmm.
without actually having to take on additional risk, that explicit risk, right? They were saying, we're going to give you par for the bonds.
Mm-hmm.
Now, mind you, these are all government guaranteed bonds, whether it's Fannie, Freddie, U.S.
Mm-hmm.
Treasuries, they're all the same thing, right?
Right.
Obviously Fannie, Freddie are offshoots, and they're risk weighted differently, but they were giving you full credit for them. And that's not, you can't always assume that, but you
Right.
can't assume that there's liquidity in the bonds you hold, right?
Mm-hmm.
Particularly if there are government guarantees involved. And so that was the biggest thing for regional banks that were sitting on these big AOCI marks was like, look, my tangible capital is down. I get it, right? And it's factual. There's no denying it. But the reality is I don't have to sell these bonds because there are markets where I'll be able to get credit for these things for liquidity.
Mm-hmm.
And that was the whole part of the liquidity rules that were out there, right? Like when you do your liquidity stress test, you don't assume par value for the bonds. You assume a market value with a haircut, and
Mm-hmm.
are fairly conservative haircuts. So I think there was that dynamic when you're thinking about AOCI and that mark. And then we talk about the other marks where I don't really have control about being able to take them, and this gets into credit risk.
Mm-hmm.
And whether it's in my if I have ABS bonds that maybe I have some credit exposure to, or I have some lower tranched or lower rated CLOs, like those can get fairly ugly. Now higher rated CLOs are historically have performed extraordinarily well.
Mm-hmm.
but then you get into your loan book, and I think you get into where loans aren't marked, right? So
Mm-hmm.
the other, we talk about CECL, and that is FASB's kind of, I don't want to say it's FASB's, but I think it is a
Yeah.
way to fair value your balance sheet without actually doing that extra step of discounting the cash flows.
Right.
But that's what CECL's doing, is it's front loading all those losses. And if you go back to the pandemic, remember CECL was supposed to get implemented that first quarter.
Mm-hmm.
And they came back, and the agencies all recognized the same thing, is we can't have banks taking these marks right now. This is not a good time.
Right.
Right. And
Yeah, I
so,
remember that.
yeah, so they adjusted the CECL implementation rules a little bit to give banks a little bit more runway to get through the implementation. And you're seeing, that was another good thing that was done by the
Mm-hmm.
regulators, and the agencies at the time. So you have to think through all of that stuff and partner with your controller teams and accounting teams, because there's some complexity in some of these things that you got to make sure you pick up the right way. And you think about things like hedging, for example, right? I'm going to fair value hedge a bond. How do I do that? Like making sure the accounting on that's right, because when you do your stress tests, you're hedging for a reason, right? You're
Mm-hmm.
hedging back from losses. And so making sure that you account for it properly and then pick it up properly in the future stress test is important.
Great. Well, Jay, I really appreciate all of these insights you shared with our listeners. Getting behind the scenes of the corporate treasurer, I think this is really invaluable to lawyers who we just get the spreadsheet that then we quickly delete. So having an understanding of why we shouldn't is super important. So thank you for being on the program. I also want to thank our listeners. Without you, we wouldn't have a reason to do these kinds of programs and get great people on here like Jay. And please tune in for the next episode of Credibly Challenged.
Thanks, man.